The Emergency Banking Relief Act of 1933, also known as the Emergency Banking Act, was a crucial piece of legislation enacted by the United States Congress during the Great Depression. It aimed to stabilize the nation's banking system, which had been severely impacted by a series of bank failures and runs on banks. Here's a detailed explanation of the Act and its provisions. Background and context. In the early 1930s, the United States was grappling with the devastating effects of the Great Depression. The stock market crash of 1929 had triggered a severe economic downturn, leading to widespread bank failures and a loss of public confidence in the financial system. As people rushed to withdraw their deposits, banks were forced to close, exacerbating the crisis. Key provisions: bank holiday and reopening process. The Act declared a nationwide bank holiday or temporary closure of all banks, which began on March 6, 1933, shortly after President Franklin D. Roosevelt's inauguration. During this period, the federal government conducted inspections to assess the financial stability of banks. Banks deemed solvent were allowed to reopen, while those in poor condition were reorganized or closed. Expansion of presidential powers. The Act granted the president broad powers to regulate banking transactions, including the ability to restrict the operations of banks, limit foreign exchange transactions, and prohibit the hoarding or export of gold and silver coin. Emergency currency issuance. The Act authorized the Federal Reserve to issue emergency currency, known as Federal Reserve Bank notes, backed by any assets of commercial banks. This provision aimed to ensure that reopened banks had sufficient cash reserves to meet customer demands. Conservatorship and recapitalization. The Act empowered the comptroller of the currency to appoint conservators to take control of banks with impaired assets and conserve their resources. It also allowed the Secretary of the Treasury, with the President's approval, to request the Reconstruction Finance Corporation, ARFC, to provide loans or purchase preferred stock in banks, effectively recapitalizing them. Impact and significance. Restoration of public confidence. The Act's measures, combined with President Roosevelt's reassuring fireside chats, helped restore public confidence in the banking system. When banks reopened on March 13, 1933, long lines of depositors formed to return their money, signaling a renewed trust in the financial institutions. Stabilization of the banking system. The Act's provisions, such as the bank holiday, inspections, and emergency currency issuance, help stabilize the banking system and prevent further bank runs. Expansion of federal oversight. The Act expanded the federal government's role in regulating and overseeing the banking industry, setting the stage for future reforms and increased oversight. Transition to fiat currency. The Act, along with Executive Order 6102 signed a month later, effectively took the United States off the gold standard and paved the way for a fiat currency system. Executive Order 6102, signed by President Franklin D. Roosevelt on April 5, 1933, was a pivotal measure taken during the Great Depression to stabilize the U.S. financial system. The order prohibited the hoarding of gold coin, gold bullion, and gold certificates within the continental United States. Here's a detailed explanation of this executive order. Background and context. 1. The Great Depression had caused a severe economic crisis, leading to widespread bank failures and a loss of public confidence in the financial system. 2. The U.S. was on the gold standard at the time, which meant that the value of the dollar was tied to the value of gold. 3. As people lost faith in the banking system, they began hoarding gold coins and bullion, further depleting the gold reserves of banks and the federal government. Key provisions of Executive Order 6102. 1. Prohibition on hoarding gold. The order prohibited individuals, partnerships, associations, and corporations from hoarding gold coin, gold bullion, and gold certificates within the continental United States. 2. Mandatory delivery of gold. All persons were required to deliver their gold holdings, with a few exceptions, to a Federal Reserve Bank or a member bank of the Federal Reserve System by May 1, 1933. 3. Exceptions. The order allowed for certain exceptions, including gold required for legitimate and customary use in industry, profession, or art. Gold coins and certificates up to $100, about 5 troy ounces per person. Gold coins with recognized special value to collectors. Gold held by foreign governments, central banks, or the Bank for International Settlements. 4. Penalties. Willful violation of the order could result in a fine of up to $10,000, equivalent to approximately $235,000 today, or imprisonment for up to 10 years, or both. Impact and significance. 1. Restoration of public confidence. The order aimed to restore public confidence in the banking system by preventing further depletion of gold reserves and stabilizing the value of the dollar. 2. Transition to fiat currency. The confiscation of privately held gold paved the way for the U.S. to abandon the gold standard and transition to a fiat currency system where the value of the dollar was no longer tied to gold. 3. Expansion of executive power. The order was issued under the authority of the Trading with the Enemy Act of 1917, as amended by the Emergency Banking Act of 1933, granting the President broad powers to regulate financial transactions during a national emergency. 4. Controversy and criticism. The order faced criticism from those who viewed it as a violation of property rights and a breach of trust between the government and its citizens. However, supporters argued that it was a necessary measure to address the economic crisis. Executive Order 6102 remains a significant event in U.S. history, demonstrating the government's willingness to take extraordinary measures during times of economic crisis. It also serves as a reminder of the potential risks associated with holding physical assets that can be subject to confiscation or regulation by the government. The Emergency Banking Relief Act of 1933 was a critical response to the banking crisis during the Great Depression. Its measures helped restore public confidence, stabilize the financial system, and lay the foundation for future banking reforms. The act remains a significant milestone in the history of the United States financial system and its recovery from one of the nation's most severe economic crises. Key court cases. Affirming the designation. Several federal court cases have affirmed that the Emergency Banking Relief Act designated financial instruments such as bills of exchange, bankers' acceptances, notes, drafts, and trade acceptances as obligations of the United States.